The stock market can seem like a mysterious beast, but it's really quite simple at its core. It's a place where fortunes can be made or lost, but understanding its basic principles can demystify it. In essence, the stock market is a vast marketplace where buyers and sellers come together to trade pieces of ownership in publicly traded companies. These transactions happen every day, creating a dynamic environment. These pieces of ownership are known as stocks or shares. Each share represents a small fraction of the company. When you buy a share of stock, you're essentially buying a tiny slice of that company. This means you own a part of its assets and earnings. The stock market operates as a platform for facilitating these transactions. It ensures that buying and selling can happen smoothly and efficiently. Think of it like a giant auction house, but instead of paintings and antiques, it's shares of companies that are being bought and sold. The highest bidder gets the shares. The price of a stock fluctuates throughout the trading day based on supply and demand. This constant change is driven by various factors including market sentiment and news. If more people want to buy a stock than sell it, the price goes up. This is often due to positive news or strong company performance. Conversely, if more people want to sell than buy, the price goes down. Negative news or poor performance can drive this trend. This constant ebb and flow of buying and selling is what makes the stock market dynamic and exciting. It's a place where opportunities and risks coexist. It's important to remember that the stock market is forward-looking. Investors are always trying to predict what will happen next. Investors are constantly trying to anticipate future events and their impact on company profits and stock prices. This anticipation drives much of the market activity. Understanding this forward-looking nature is key to grasping how the stock market truly works. It's a blend of current performance and future expectations. When you place an order to buy or sell a stock, it sets off a chain reaction behind the scenes. In today's digital age, most trades are executed electronically. You'll likely interact with an online brokerage platform or a stockbroker to place your order. Your order is then transmitted to a stock exchange, where it's matched with a corresponding order from another investor. The actual matching of buy and sell orders can happen in a matter of milliseconds. Sophisticated computer algorithms handle much of the process, ensuring efficient and rapid execution. Once the trade is executed, your brokerage account will be credited with the shares you purchased or the proceeds from the shares you sold. It's easy to take this seamless process for granted, but it's a testament to the advancements in technology and the interconnectedness of global financial markets. The speed and efficiency of modern stock trading have made it easier than ever for individuals to participate in the market and build wealth over time. The stock market plays a crucial role in modern economies by facilitating capital formation. When companies need to raise money to fund expansion, research and development, or other initiatives, they can issue stock to the public through an initial public offering, or IPO. This allows investors to purchase shares of the company, providing the company with the necessary capital to pursue its growth objectives. By enabling companies to tap into public markets for funding, the stock market fosters innovation and economic expansion. Without access to this vital source of capital, many businesses would struggle to grow and thrive. The ability to raise capital through the issuance of stock fuels entrepreneurship, job creation, and overall economic prosperity. The stock market also provides a mechanism for existing investors to realize returns on their investments. As companies grow and become more profitable, the value of their shares tends to increase. Investors can then sell their shares to other market participants, potentially earning a profit on their initial investment. Companies that list their shares on a stock exchange are known as public companies. Going public comes with certain obligations and responsibilities. Public companies are required to operate with a high degree of transparency, disclosing their financial performance and other material information to the public through regular filings with regulatory bodies. These reporting requirements are designed to protect investors and ensure a level playing field. By providing investors with access to accurate and timely information, regulators aim to promote fair and orderly markets. Investors can use this information to make informed investment decisions based on a company's financial health, growth prospects, and management team. The transparency demanded of public companies is one of the cornerstones of a well-functioning stock market. It fosters trust between companies and investors, which is essential for the long-term health and stability of the market. Section 5, Guardians of the Market, the role of regulation. The stock market is not a free-for-all. It operates within a framework of rules and regulations designed to protect investors and maintain market integrity. In the United States, the primary regulatory body overseeing the stock market is the Securities and Exchange Commission, or SEC. The SEC's mission is to protect investors, maintain fair and orderly markets, and facilitate capital formation. It enforces a wide range of regulations covering everything from insider trading and market manipulation to corporate disclosures and the activities of brokerage firms. The SEC plays a critical role in ensuring that the stock market operates fairly and transparently, giving investors confidence in the system. By setting clear rules and enforcing them rigorously, regulators strive to create a level playing field for all market participants. This regulatory oversight is essential for maintaining investor confidence and fostering the long-term health of the stock market. Section 6. The Price is Right? Understanding stock valuation. Determining the right price for a stock is both an art and a science. It requires a deep understanding of various financial metrics and market dynamics. Stock prices are influenced by a multitude of factors including company performance, industry trends, macroeconomic conditions, and investor sentiment. Each of these elements can sway the market in different ways. Understanding these factors and how they interact is key to making sense of stock valuations. It's a complex puzzle that requires constant analysis and attention to detail. One of the most fundamental factors driving stock prices is a company's earnings. Earnings reports provide a snapshot of a company's financial health. Investors pay close attention to a company's profitability and its ability to generate future earnings growth. This information helps them gauge the potential for long-term success. Other important factors include revenue growth, profit margins, debt levels, and the strength of a company's management team. Each of these can significantly impact investor confidence. Macroeconomic factors such as interest rates, inflation, and economic growth can also have a significant impact on stock prices. These broader economic indicators often set the stage for market trends. For example, rising interest rates can make stocks less attractive to investors, as they may offer lower returns compared to other investment options. This can lead to a shift in investment strategies. Ultimately, stock prices are determined by the collective actions of buyers and sellers in the market. Their decisions are influenced by a mix of rational analysis and emotional reactions. When investors are optimistic about the future, they tend to bid up stock prices. This optimism can be driven by positive news or strong economic indicators. Conversely, when pessimism prevails, stock prices tend to decline. Negative news or economic downturns can trigger a wave of selling. Section 7. Investing 101. Why people buy stocks. People invest in the stock market for a variety of reasons. Some investors are primarily interested in generating current income through dividends. Dividends are regular payments made by companies to their shareholders, typically out of their profits. Other investors are more focused on capital appreciation, aiming to buy stocks at a lower price and sell them later at a higher price, thereby realizing a profit. Long-term investors often take this approach, seeking to benefit from the power of compounding returns over time. Some investors purchase stock to gain voting rights in a company. By owning shares of stock, investors become part owners of the company and are entitled to vote on certain corporate matters, such as electing members of the board of directors or approving major corporate actions. The motivations for investing in the stock market are as diverse as the investors themselves. Understanding these motivations can provide valuable insights into market dynamics and investor behavior. Section 8. Markets and Exchanges. Differentiating key concepts. While the terms stock market and stock exchange are often used interchangeably, there is a subtle but important distinction between the two. The stock market is a broader concept that encompasses all the buying and selling of stocks, regardless of the platform on which these transactions occur. Stock exchanges, on the other hand, are physical or electronic marketplaces where stocks are traded. These exchanges provide a centralized platform for buyers and sellers to come together and execute trades efficiently and transparently. They act as intermediaries, matching buy and sell orders and ensuring the smooth functioning of the market. Examples of major U.S. stock exchanges include the New York Stock Exchange, the Nasdaq stock market, and the Chicago Board Options Exchange. Each exchange has its own listing requirements, trading rules, and investor base, contributing to the diversity and dynamism of the overall stock market. Section 9. Giants of Wall Street, Major U.S. Stock Exchanges. The United States is home to some of the largest and most influential stock exchanges in the world, serving as the heartbeat of global finance. These exchanges play a pivotal role in global capital markets, connecting businesses seeking capital with investors seeking growth opportunities, and facilitating the flow of money and resources. The New York Stock Exchange, established in 1792, is the oldest and largest stock exchange in the United States, renowned for its iconic trading floor, where the hustle and bustle of traders create a dynamic and energetic atmosphere, and its listing of many of the world's largest and most established companies, making it a cornerstone of the global financial system. The Nasdaq stock market, founded in 1971, is a global electronic marketplace known for its focus on technology and innovation, revolutionizing the way stocks are traded with its cutting-edge electronic trading platform. It is home to many prominent technology companies, including giants like Apple and Google, and is renowned for its volatility and growth potential, attracting investors looking for high returns. The Chicago Board Options Exchange, established in 1973, is the largest options exchange in the world, specializing in trading options contracts, which are financial instruments that derive their value from an underlying asset, which give investors the right, but not the obligation, to buy or sell an underlying asset at a specified price and time, providing flexibility and strategic opportunities. These options can be used for hedging, speculation, or income generation, making them a versatile tool in the financial markets. These exchanges, along with numerous other regional and specialized exchanges, form the backbone of the U.S. stock market, providing a vital platform for capital formation, investment, and economic growth. Their influence extends far beyond American borders, shaping the global financial landscape and impacting businesses and investors worldwide, driving innovation and economic development on a global scale. These exchanges are not just financial hubs, they are the engines of economic progress, fostering growth and prosperity, and impacting businesses and investors worldwide.